Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate.
It was initially the 12% return, but it quickly turned into the people.
All right, excited to have another episode of Kiss My Assets today. Thanks for joining us. And I am Jameson Manwaring, CEO of Neighborhood Ventures, and excited to have Bart Dill with us also, Director of Investor Relations. Hey, Bart.
Hey, guys.
So today we're going to jump into one of the, I think, most important articles I've seen in a while from the New York Times. They had a podcast and a discussion about should you buy or should you rent right now. And looking at all the data, it was really clear that right now it's better to rent, potentially buy later, but renting now makes a lot more sense. And we've seen this in the data where right now it is the highest point it's been in 40 years. If you rent versus buying the equivalent home, the gap is about 50% higher if you buy that equivalent home to renting. The last number I saw was 53%. And this is the data that New York Times dove into as they looked at this question. And they got a quote from Moody's. The analyst there, the chief economist, says, "This is not the time to buy for most people. Mortgage rates are very high and house prices are extra high, and there's not much to choose from in the market." He then said, "If you find the perfect place, then all means buy it, but most people are not going to find it." And as the financials kind of flow through our economy and they start to flow into our psyche and kind of our culture, more people are realizing that the kind of intrinsic benefits of owning a home are so far outweighed by the costs of buying a home. And, mortgage rates have come down in the last week, but they approached 7.25% just a week ago before Thanksgiving, a couple weeks ago before Thanksgiving. And housing prices are up 386% since 1987. Housing prices are way up. You can see the chart here. So you can see both interest rates. If you're watching on YouTube, you can see how high those are historically, especially over the last 20 years, up to 7.29%. And then the cost of housing is also way up. And the other thing is they said, as all things with real estate, it's very local. And since they're in New York, they are talking about what they call the Bronx exception. So Bronx is an interesting area of the 5 boroughs in New York. It's a lower cost area. There is some expensive rental housing there and some less expensive housing to buy. And so the Bronx exception basically is in that area, if you want to live in the Bronx, you can find some deals where that gap is a lot less than 50%. And you can find those Bronx exceptions in different areas across the country. So you do have to dig into the details here, and the devil's always in the details. But broadly, this was a pretty important article as they come to the end of the year, talking about now is really not the time to buy.
Yeah, and I think it's less of a preference thing of buying versus renting anymore, and it's based a little bit more on necessity. For a millennial to buy a home right now, unless you have a lot of liquidity already to put a down payment on your home, it just doesn't seem like it makes sense. I actually didn't read the article, but I did read some of the transcript of the commentators talking about this article.
Yeah, because they had a podcast,
the
30-minute podcast on, and I'd recommend we'll put the link here to listen to it.
So I'll go over the 4 expenses as a homeowner that is also considered as throwing money away, because many folks think that by renting you're just throwing money away, but they have a different perspective as well. So First, and Jameson, you can riff on any of these, but first is a 6% broker fee or real estate agent fees when you're selling a home. So if you ever intend to sell, you typically will pay this fee. And on, let's say, a $500,000 home sale, that's about $30,000 you're going to have to pay. So that's one expense that these folks talk about as throwing money away. And then number two is interest on your mortgage. So especially now, as interest rates are so high, you end up paying a significant amount of money just in interest rates. And many mortgages, the way they're structured now, your first maybe 5 years of paying your mortgage, it's just interest. You're just paying your interest rates. Number three, another expense that they consider us throwing away is as a homeowner, every year you will have to make your repairs. Renters, they don't have to pay that. So that's a big one. And then the fourth and last one is your down payment. So let's say on average, the 20% purchase price of the home. So on a $1 million home, you got to have $200K to put down on the home. Whereas a renter, if they had that same $200,000, they could put that into something like, NV REIT and see some cash distributions and get some passive income.
Yeah. So let's even just say you put it in some investment that's paying an 8 or 10% return. Those four things really are interesting because, or if you buy a brand new car, the moment you drive it off the lot is when it loses the most value. And it's actually the same for a home. When you buy a home, all of a sudden now, if you want to sell that, you're at least 6% closing costs. It's normally more like 8% because you have the commissions and then you have all of the title insurance and other escrow costs, inspections, etc. So once you buy that home, if you decide to sell it, you're around 8-10% below the value already just if you wanted to sell it. Then maintenance is 5-10% a year of the value. Mm-hmm. And typically, as we underwrite apartments, that's what you want to put in rental properties. You're going to have ACs go dead. You're going to have roofs that need to be repaired. You're going to have broken sinks, all that kind of stuff. And yeah, those costs are not insignificant. A lot of people think you need to buy a home because you're going to get the value appreciation over time. And so you need to go buy that home to start building that. If you can buy the home at $500,000 and over 20 years it goes up to $1 million, mm-hmm. you've got those gains. But if you invest that money instead and you're renting, that works just as well. What you can't do is just spend the money.
Yep.
If you spend all that money and you don't have any investments or any savings and you're not doing that, then go buy a home to force yourself to put the money in. Otherwise, if you can be disciplined, the math kind of comes out. It's better to rent.
Yeah.
One thing broadly with apartments that we're seeing right now is that the capital markets are where we get financing to buy these buildings has really been stifled. And this started and was really the biggest catalyst was when Silicon Valley Bank and Signature Bank failed. And if you remember, the reason why they failed was because they had taken a significant amount of their portfolio and invested it in long duration T-bonds, treasury bills. And this is a safe investment because it's backed by the federal government. It's the safest investment, arguably, that exists. But the problem was when the bank did that, they locked up that money for like 10 years. And as there were some questions around its financial solvency, people started pulling money out. And in order to cash out those long duration bonds, you have to cut the value way down. At the time, it was about 50% of the value. And so quickly there was a run on the bank, something we hadn't seen in a long time. Mm-hmm. And what this ended up triggering was a lot of regional smaller banks who normally would be in good financial health. They realized that they wanted to keep more of their capital and more of the deposits in cash for a while so that they didn't run into a similar problem. If you keep more in cash or liquid assets that you can sell immediately, then you're good to go. But as the Silicon Valley Bank ran into this issue, a lot of other banks who typically lend a lot on commercial real estate, which is also a long duration hold. You cannot quickly get liquidity out of real estate. A lot of those banks also temporarily pulled back their financing options. The good thing with multifamily is you always have government debt available. The government sponsors debt. They will underwrite debt for multifamily because housing is so critical. That's something you don't have with office, retail, and other commercial real estate assets. But this article from Globe Street talks about multifamily capital markets continue to struggle. This year, the multifamily sector is down 55% in the third quarter. Lending is down 55%. So that is pretty significant given in order for transactions to happen, people have to borrow money. So if lending is down 55%, they're not borrowing that capital. Transactions are not occurring. From Q2 to Q3, loans went down 33%. So we're seeing a big increase. So we're seeing a big decrease, rather, on the capital that is available and that is being deployed into multifamily. And it doesn't say here how much of the loans that did happen were government loans, but I would expect a lot of those loans are government loans. So shifting over to some Phoenix and Arizona specific items. Phoenix is now top in the nation in 2023 for multifamily construction. So anyone who lives here, as you drive around, you see a lot of these buildings going up
everywhere.
Every neighborhood, especially the more central core areas, Phoenix, Scottsdale, Tempe. And as you drive out, there's a lot on the outskirts as well.
Yeah.
It is a lot of these projects were planned several years ago. It's usually about a 2-year turnaround to get these projects done. And there are various levels of completion. Some are really close to getting done. Others are halfway through.
Mm-hmm.
Very few of these are newly started because as interest rates started to climb over the past year, people stopped planning these. But the ones that you're seeing now, they were planned several years ago, and now they're just being executed and finished out. And there are some hot markets when it comes to multifamily construction across the country. So there's some Texas markets, there's some Florida markets.
The top three are Phoenix with 20,541 new units delivered, Austin, Texas with 20,293, and then Denver, Colorado with 16,664.
And in a normal year, the Phoenix Metro delivers about 8,000 units.
Yep.
So we talk a lot in this podcast about supply and demand and how this really drives rents. It drives value of homes. And so when you add this level of supply, number one in the nation in one metro area, 20,000 units. Austin, Texas comes in second with 20,293, and then Denver at 16,664. But when you add 20,000 units in a market, you begin to see the advantage is basically to the renter today.
Yeah.
Because all these units have been delivered. Arizona gets about 100,000 people who move here every year to Phoenix. So they have to live somewhere. And that's the total. So normally we need about 12,000 units, 12 to 15,000 units to support the current demand. And we got 20 this year. So we got way more units than we have in a long time. So today, and this is what we're seeing in our properties as well, it's advantage renter. And you have to, as an investor, not just look at where we're at, but you have to also look at where we're going. So let's talk a little bit about where we're at. This year, rents have been about flat as all of these new units have come on board and they've really leveled out the cost of rent. Rents are about flat. They haven't gone down though. And on a year like that, this was kind of the concern as rents might go down 10 or 15%. So far in the data, we're seeing rents are flat across the board, but we are seeing it's taking longer for these new buildings to get leased up. They are getting leased up, but it's taking longer. And people have more options now when they're renting. If you're out in the rental market, it's actually a good time. And that's new. Most people, when they talk about the rental market, they're complaining that it's not affordable. The rents have skyrocketed. It's not the case. In the last year, rents have actually been flat. And that's where we are today. We're in a stable market, but it has not moved up this year. But we got to talk about not, as Wayne Gretzky used to say, not where the puck is, but where is the puck going? So as we look at where rents are going, the and where supply and demand is going, the important thing to look at is that projects that are getting started has hit a cliff, and there's that metric has nosedived. Once this slew of apartments gets completed, there is going to be a lack of supply for several years now, 3-4 years, because again, it takes 2 or 3 years to get these projects planned. So as a multifamily investor, now is the time you want to buy. You want to buy and hold and get through the next few years. We're going to see increasing rents. In my opinion, we're going to see increasing values. Values and rents have not gone down. They've been stable through this cycle. And now as we get out of that, we continue to see growth in Phoenix. And now there's going to be a big drop off in supply. Next year, we'll probably see around 12 to 15,000 units. And then as we look to 2025, it's probably going to be a couple thousand. And that's when rents will really be impacted. So a couple other positive announcements in Arizona. This new $2 billion plant that is being built near the TSMC semiconductor manufacturing site in North Phoenix. This company, Amkor, which is already existing in Phoenix, they are now ramping up their production capabilities to support the TSMC semiconductor facility. And they have a $2 billion investment in their new plant. So the biggest investment, around $40 billion, is around the TSMC plant. But we also knew that as they came in, they're really creating an ecosystem that is around chips and chips needing to be supported, in addition to the Intel plant that's more in the East Valley, which is a huge investment as well. So what happens is we've take these suppliers of Intel and TSMC. Now they have to have a bunch of suppliers that are going to support their manufacturing of the chips. And that's what Amkor is doing. And we'll continue to see these types of announcements as the Arizona ecosystem for chips continues to grow.
Yeah, and I think about job growth too in Arizona, especially the Phoenix metro area. And it's just coupled with the fact that we're going to have all these units being delivered in the next few years. This is why we're putting a lot of money into becoming the tech manufacturing capital of the Southwest. And I think it's a good thing.
Yeah, we are really well positioned strategically, geographically, for to become that hub. And that was the aim of the government and of business leaders, and it's really coming to fruition. And we have to think about that. Not for today, but as an investor over a 10 or 15 year period, how that impacts housing, how that impacts values. Going back to supply and demand, those folks need a place to live, and they tend to be higher income folks. They'll want higher amenities, more technology. Many of them will be home owners. So that ends up driving the cost of real estate up. So if I were to ask you, what would be the 2 cities in Arizona where Gen Xers want to move to, what would you say?
Without context of the article or with context?
No, if you didn't know. So I guess I can't ask that question because you already know.
Well, before the article, I assumed for sure Scottsdale.
Yep.
Why would you not want to live in Scottsdale?
So that's one. One is Scottsdale. That is one of the cities.
And then Gen X, just giving the age group, I would say Fountain Hills.
Oh, okay.
There's plenty of folks around that age moving to Fountain Hills.
Fountain Hills is expensive, though, isn't it?
Yeah, it's a little bit more expensive. Yeah.
So I think those are good guesses. Scottsdale, right on. It was a surprise. The second city was surprise.
Wow.
Surprise that it was surprise. Second city in Arizona where Gen Xers are moving. And I think I would probably put it this way, and this is a generalization, but if you're a single Gen Xer, you might live in Scottsdale.
Yep.
If you're coupled and you're starting a family, you're going to move to Surprise.
Yeah.
But these are 2 of the cities among top destinations where Gen Xers are going.
What's crazy is we had a holiday party last week, and so many of our investors live in Surprise. I had no clue they made it. It's a 30-minute drive out here. They came to our event from Surprise, and a lot of them talked about the growth in the communities. The pickleball community out there is apparently amazing, which is really cool. Plenty of really good golf courses as well.
Yeah. No, it's a nice place. Another big announcement is this new project Pivotal Group is doing in Midtown Phoenix called Central Park. So if you've lived in other cities and you come to Phoenix, one of the big things that's lacking are nice parks in the city. A lot of cities devote a lot of investment to their parks in the central areas, and we do have a few good parks. I live in Midtown, but the biggest park that always stood out to me was Indian Steel Park, and how well positioned it was when you look at the city map. And it's really in the middle of the city. It has a really nice footprint, but it's a park that really has lacked a draw for people who live around here, and it doesn't have this this feel. Obviously, Central Park in New York is the crown jewel of providing a place for people who want to live urban, but to kind of escape to a park. So I'm really excited to see this this announcement. Pivotal Group has been working on this project for a long time. The southwest corner where Still Indian School Park is, there is a big vacant space, and that is the space that Pivotal Group owns. And they had announced to build some towers right there in central Phoenix, right on the park. And the plan was to make office towers, and they've now changed the plan to have it more heavier weighted to multifamily to support the need for housing and not so much need for office. There is still some office there, but if you're watching on YouTube, you can see this rendering from above. This is a really cool rendering. Shows some of the cool aesthetics in the park that are these circles, circle driveway, and then there's this other feature in the park. There's some lakes there. It's adjacent to the canal, and what they want to do, and the quote that really stood out to me because it resonated with me as somebody who wants to see this area really do well, is the developer said that this park is a 74-acre gem in the city of Phoenix. You could drive past it and not even realize it was there. It's largely because we've got this 15-acre site on the corner that separates the street from the park. We want to bridge that gap and become the gateway to Still Indian School Park. And the way that they've laid this thing out, it's really designed to be a community draw to the retail, to the shopping, and then to feed you into the park. And I really am excited about this project.
Yeah, looking at the designs of it, it kind of reminds me, not the designs of what's going in the park, but just how it's laid out. Grant Park and Millennium Park in Chicago, whereas Michigan Ave, you have all the shopping you could ever want. And then in between these two parks, there's multifamily, there's plenty of things that are going to draw residents to these attractions.
This is really the urbanization of Phoenix that's occurring right now. About a mile south of this development is Park Central. Mm-hmm. So we got Central Park and Park Central, which is another big development on the light rail. Light rail runs straight down Central, so it'll go right past the Indian School stop. There's also a lot of multifamily going up here that is 7-8 stories high. So it's the density that's being increased in Central Phoenix. It's the urbanization, and I think it's exciting because we've done it right. We have the public transportation with the light rail and the freeways, I-17, I-51 that are really close, and I-10. So as someone who lives there, cares about this area, I'm really excited about this. And it also just points towards where we're going as a city and as a state. This project, now these changes have to be approved through the city council. The prior project had already been approved, so now this one needs to go through. I hope the city council supports it, and really excited to see this thing come out of the ground.